right, we're going to go ahead and get started. Thank you so much for being here. I appreciate it. We're just going to go through navigating the loan process today. This is interactive, so if you have questions, feel free to stop me. Just raise your hand, and I will do my best to get all of your questions answered today. All right. So as you guys know, there's a number of different lending institutions that exist out there. There's a mortgage banker, there's banks, credit unions, and then there's what we are, which is mortgage brokers. So you can see here, there's a little bit of a difference. So mortgage banker has money, like their own money, their own underwriting, multiple guidelines, multiple rates, can be a direct lender. Everything's normally on site or at least at a corporate location. And then they have normally their own appraisers. And then banks and credit unions, again, have their own funds. They have underwriting. They have one set of guidelines, one set of rates. Can also be direct lenders, typically not on site for underwriting and processing. And then they have an AMC, which is an appraisal management company. And then there's us. So we work with a number of different banks. So we do not have our own money. We do not do the underwriting. The underwriting actually goes to those banks for their underwriters to review. We're often working with multiple guidelines, multiple rates, which is great for your clients because it lets us shop the rates for them and try and get them the best rate out there. We are not a direct lender. For us, our processor is not on site, but Hallie is absolutely phenomenal. And she's always available. So if you ever get the opportunity to work with her, just know that she is definitely a little bulldog and will do everything in her power to get it done as fast as possible. And then obviously our underwriters are whichever bank we are going with. And then we also work with an appraisal management company, depending on which lender we are working with. Yes.
You mentioned direct, can be direct, not direct. What does that mean?
So direct lending means that they are lending directly to you. So for the most part, they are probably going to handle your loan after it closes versus actually selling it off in the market, the secondary market after it closes. So it really depends on which bank you're going with and how they're handling it. So previously, at my previous job, if we closed a loan, there were some loans that we kept in-house, so we direct lended on, and so we handled those loans after they closed. And then there were other loans that we did not direct lend on, and those were sold in the secondary market. So that's the case where your client's going to get a letter in the mail saying, hey, your loan has been sold to Wells Fargo, Chase, whatever bank it is. And then they're going to get a second letter in the mail that's going to come with the little packets of payment slips for them to do. And of course, they can always set up an online account because I don't know of anybody who doesn't have that available right now. All right. So we all know we talk about pre-qualifications versus pre-approvals. This is a little bit about pre-approvals for you. Surprisingly, not always accurate. Depending on who your loan officer is and how much they know, pre-approvals should be very accurate and reviewed correctly. As you can see, true accuracy is when the documents are reviewed by an experienced LO. Sometimes even a newer LO that has an experienced loan officer behind them that's doing training or helping review files is still a really great option for you because you're getting that additional years of experience. DU approval is what we call underwriting approval. It's when we run it through the automated system for Fannie Mae or Freddie Mac, and it lets us know whether your borrower is qualified or not. Again, that's only good if the info is entered correctly. Rates don't really mean anything. As you know, they can be bought down. They really vary on what your client is working with as far as their credit score, money down, etc. FHA, surprisingly, it can be a little bit easier than conventional. And the down payment amount means nothing, especially right now in this market. I don't know if you guys have been paying attention, but with everything that's been going on with the conventional market, they are really pushing FHA loans, which means that our conventional buyers with really good credit are actually taking a big hit right now. So it doesn't always make sense for your borrower to put down 20%. It's not always a benefit to them at this point in time. Does that make sense to everybody? I can't see if there's questions, so.
I'm watching this.
Okay, perfect. Thank you. All right. So you get your client into contract, your purchase agreement is signed. What should happen next? So your loan officer is going to go ahead and pull a property profile. We use Old Republic, Fidelity. It kind of just depends on who your loan officer likes to work with for escrow. We're going to pull accurate taxes. So we're going to go onto the county's website. We're going to pull taxes directly from there and calculate them. So when we submit that file, we have the accurate taxes. The official loan application is prepared. This is the application that's going to be sent over to the bank. The loan estimate is going to be issued and then signed by your client. You can have inspections at this point. We do order the appraisal as soon as possible. The only time that we would delay ordering an appraisal is if we have something from you guys that might give us a reason to delay that. It does not normally happen. We have had a couple of times that it's happened, but it's not normally a regular thing. And then this is when we're going to go through your client's file and we're going to see, do we need updated bank statements? Do we need updated pay stubs? Any other documents that might need to be updated so we can submit it to the bank as soon as possible and get your client moving forward with their purchase. All right. So what should happen next? We send the file to processing. So again, this is where we send it over to Hallie. And we are going to get it over there within 24 to 48 hours. Then she's going to send it over to underwriting for our initial quality review. We're going to order appraisal, anything else that we need to order. Title is going to be open, credit supplements are going to be ordered, and the appraisal is going to be ordered. And this, yep, go ahead.
What would be a credit supplement?
So credit supplement, if they're, let's say you have a borrower who paid off some items, sometimes we have to get a credit supplement to show that they have paid off those items. All right, throughout the transaction, at least for us, this is what we like to do. Weekly phone updates, weekly email updates, constant follow-up with the clients for their documentation. As we all know, clients are not always the best at getting us their documents as quickly as they should. And so sometimes that can be a little bit of a hunting game. So we're going to try and help you manage the clients, manage their fear, and manage those expectations for both you and the borrower. So for us, a great thing for you to do, especially if it's your first time working with us, is let us know. We'll normally ask, but let us know how you like to be communicated with. Do you want us calling you? Do you want us emailing? Do you want text messages? How often do you like your updates? Because if you like them more than once a week, we can definitely do that. Most of the time, unless there is an update with your file, it doesn't make a lot of sense to do it, but we are more than happy to just give you guys updates however you would like. All right, as documents arrive, what should happen next? At this point, the clock is ticking. So every document has to be reviewed by the loan processor to circumvent issues early on. And this is normally, again, weeks before closing. We're talking within the first 24 to 48 hours. Hallie's going to go through them, double check. She's going to get the information back from underwriting, review, see what else we need. Because sometimes there are documents that we need prior to funding. Sometimes there are documents that we need even sooner than that. And so we work as a team together to make sure that we get those on time. All right, so this is where Hallie submits the loan to underwriting. It does normally take 24 to 48 hours for their underwriters to review and send it back to us. This is where we're going to go back to your client, request any additional conditions, and make sure that we have everything for that file. Sometimes there are letters of explanations. For those of you who are newer to the business, this can be explaining like a gap in work history. It can be explaining deposits into their bank account. So when we get their bank statements, we have to go through and we have to look at every single transaction on those bank statements to see if there's something that's going to flag an underwriter to potentially give us a condition when we send it into them. All right. CD or the closing disclosure. When does this happen? So once we have a conditional approval from underwriting, we're going to go ahead and issue that closing disclosure. So we're going to issue the initial closing disclosure, which is going to start a 3-day clock. This does not mean that this is your final closing disclosure because sometimes things do change during the transaction. Once we have that signed and back, then we're going to finalize clear to close after that closing disclosure is signed. So you can see here, if the CD is issued and acknowledged on a Monday, then we're probably looking at a closing on Thursday. So once the CD is issued, the borrower is going to acknowledge it. We can close 3 days afterwards. The final conditions will get sent, the file gets cleared to close, and this is when the quality control is completed from underwriting. All right, closing day prep. So on closing day, and normally actually before closing day, what's happening is that title is working with Hallie to go back and forth on that settlement statement to make sure that our numbers are lining up. So we all have the same numbers. They're going through balancing everything. The wire is going to get ordered prior to the day of funding most of the time, unless something is going on that's going to delay us until the day of. The wire will be sent out the morning of closing, and normally the funds arrive at title within 20 minutes. So it does not take that long. And our funders at the banks are really great. We have not had any issues with them. So if you guys ever have any questions, just let us know. Sorry, I keep clicking the wrong thing on my mouse pad. All right, what should happen next on closing day? So as you can see, this is a little sample of the closing disclosure here. So your borrower is going to go ahead and sign the closing disclosure. They're going to sign all of their other documents. And then the funding number is going to be issued as soon as we get those documents back to the lender. All right, keys for deal closing on time or early. So obviously the more work that we can do upfront, the better. If we have a client that you have sent to us for a pre-approval that has something wonky or that we're concerned about, we will actually send it to underwriting prior to your client getting into contract to make sure that we are not going to run into an issue once they are in contract. This can be anything as far as like if they have a gap in their work history. Let's say that they're really young. For example, we have a client right now who is 23. His work history is not that long, and he is now working as a carpenter. Well, initially, you don't just go in and start as a carpenter, you start as an apprentice and then you move up. So not only does he not have a 2-year work history, but his pay drastically increased when he actually made carpenter. And so those are things that we like to have the underwriter review just to make sure that we're going to go ahead and get that exception from underwriting to go ahead and get your client closed should they get into contract. This goes again with catching problems before your client writes the offer. It has a lot to do with the staff that you're working with. And then, of course, everything needed on a file is ordered within 24 to 48 hours of receiving the RPA once you guys are in contract. All right. Here are a couple of reasons that you can run into last minute problems. A lot of people tend to think that it is the underwriter's fault. And don't get me wrong, occasionally we have ran into issues where underwriters do ask for weird things. But normally that doesn't happen if we've prepped the file correctly at the beginning. So right here, if you're doing a short sale, or a foreclosure, sometimes the time frame is not met depending on what's going on there. Income not qualifying. If something has changed in their job, let's say that they took a cut in pay or a cut in hours, and the underwriting team calls and does a verbal verification of employment and finds out that something like this has changed, then their income is no longer going to qualify. Down payment cannot be sourced. This one doesn't normally happen a lot. just because of the fact that we're normally sourcing that down payment up front. But if you do have a client who's getting gift funds, sometimes if they decide to move those funds from, let's say the dad's going to gift the funds to a daughter. Dad takes those funds, dad moves those funds over to the daughter's account, and then daughter wires those into escrow. We don't want your client doing that. We want dad wiring those funds directly into escrow so that there is no chance of underwriting going, we can't source this down payment and now we can't close, even though the money's at escrow. My favorite one, client goes out, makes a large purchase. They go out, they buy a car, they buy new appliances because they're really excited about moving into the new home. And now it's pushed their debt to income ratio over the limit, and we can no longer qualify them. When we get their updated bank statements, if they have suspicious deposits that are now on there that cannot be sourced, and these are funds that they're using for closing, underwriting is going to shut it down and say, absolutely not, we cannot do this. So mattress money is a no-go. Please let your clients know ahead of time. And then something in the financials that never got qualified. Again, this is something that doesn't really happen a lot. Normally it happens if a client decides to switch which account that they're pulling money from. And let's say they were using a savings account. Now they're pulling funds from like a brokerage account and they put it in and underwriting doesn't like something about it. Sometimes that can cause the loan to not close, or it can give us a headache and require additional documentation. Yes.
You mentioned mattress money. So if my client did have mattress money, how would they be able to use that?
So if your client does have mattress money, normally those funds need to be deposited into the bank and they need to sit in season is what we call it. Depending on the bank, that can be anywhere from 3 to 6 months. So once it's in there, then you're good. And it can still get a little weird sometimes, but normally if it's not showing up on their last 2 months bank statements, we're normally okay. All right, so this is what should happen when you have a loan. Great loan file up front. Every condition gets reviewed immediately. The TRIDS is started after approval, and then final quality control should only be a verbal verification of employment and double checking their credit. Because again, we have to make sure that nothing has shown up like a brand new car or those appliances that push us over our debt to income ratio. All right, I know I went through that really fast and I apologize. But I would love to answer any questions you have about the loan process. If you have questions about different loan options, this is your chance to ask all those questions. It is a very quiet group today. I see Trinity hopped on. So hi, Trinity. Hi, Maya.
Hello. Hi. I kind of missed all of it. I joined at the very end, so I apologize.
Well, I wasn't actually sure how long we were doing today, so I did keep it a little bit shorter. So my apologies. Do you guys have any questions about what's happening with the market right now, as far as like conventional pricing? Do you guys know what's going on with that?
Tell us. I've heard rumors.
Okay. Thank you. I'm like, so as I mentioned at the beginning of this call, and I'm sure you guys, if you've been coming to the association meetings, you've definitely heard us talking about it, because I know Jason Russell's mentioned it a couple of times, and so have a couple of other lenders. So a while back, what ended up happening is they came out with this new rule that essentially if you don't have over a 780 credit score for a conventional, you're going to take a hit. And what everybody was being told is that this was not going to affect your clients until May 1st. But the reality is that that pricing and these new conditions were actually rolled out about a month and a half ago, because they were prepping for loans that were going to close after May 1st. So right now, if you, give me 2 seconds, sorry. I have it saved on my phone.
While you're pulling that up on your phone, when you say hit, what do you mean take a hit?
So by taking a hit, you're actually going to pay additional pricing on your rate, which used to not happen. If you were doing a conventional loan and you had a score over 720, you were getting better pricing, right? It was your reward for taking care of your credit score, making your payments on time, being that ideal credit candidate. That is no longer the case. When they rolled out these new rules, now what's happening is if you have a 740 FICO score or higher, you're paying an additional 1% fee on your rate, which means you're going to see almost 1% higher in your cost than someone who has, let's say, a 620 FICO score. They are now getting a 1.75% fee discount on their rates. And the reason that they did this is they are really trying to push FHA backed loans. So the mortgage insurance on FHA loans went down from 0.85 bips, which is basis points, to 0.55, which is great for FHA clients that are out purchasing, because this means that their mortgage insurance every month is less, which is absolutely phenomenal, and we love it. The problem now is that your conventional clients who have 20% down, have an 800 FICO score, are not getting a better rate. They're getting a worse rate, which is costing them more money. So that's why you're going to hear lenders from now on saying, you don't need 20% down. Having 20% down does not necessarily make it a better transaction for your client. Now, there are certain deals where you have to have a minimum of 20% down. Normally, those are investment properties, not your normal conventional FHA or VA loans. But you're not going to see that saving grace on your interest rate anymore for your clients that have 20% down and the really good credit score.
Is the FHA mortgage insurance, is it still unrefinanceable? Where you can't take it off with a refinance, or not take it off with, you can only take it off with doing a refinance?
With doing a refinance. So I ran numbers yesterday, actually for one of the realtors here in the office. And we ran it 20% down for one of her clients who has an 800 FICO score. And FHA still has mortgage insurance on it. So they do not get out of that for having the 20% down. They're actually going to have to refi out of it into a conventional loan, which, as I said, right now is what they're trying to talk you out of doing by making conventional rates a lot higher. So it has been quite the little battle.
Are there still USDA loan products?
There are still USDA loan products. So if you guys don't know what USDA loan products are, they are for rural areas, and they're great because they're actually really similar to VA loans. You do not necessarily have to have a down payment in order to get into a USDA loan. You do, however, have to buy a house in a qualifying area.
Does winter still qualify?
You know what? I haven't checked in a while. So I would have to double check. Amy was asking if Winters still qualifies for USDA. And I know it used to be sections of Dixon did as well. So I'll double check and get back to you guys on that. Also, VA funding fees are now cheaper, which is fantastic for all of your VA clients. They should be loving that. And again, VA, 0% down. And we can normally go higher on their debt to income ratio. VA has really weird and wonky rules when it comes to that. So sometimes if you have a VA buyer that has higher debt, we can still get them into a loan product. Can you guys think of any other questions?
It looks like Winters and all of Dixon
are still qualifying?
Yeah.
Good. So Winters and Dixon are still good for USDA loans, which is great because I feel like they should. Well, yeah, parts of it, right? Kim lives in the really nice part of Dixon. One of the other things that we should probably touch base on real quick, if I don't lose my thought here, because it's like splitting out. I totally just lost it. Sorry. Like it just went straight out of my brain. If I remember, I'll let you guys know. Okay, I think that's all I can think of right now. If you guys don't have any more questions. Everybody is really quiet.
How fast is Brickhouse able to close loans these days?
Oh, that's a great question. How fast can we close a loan? So if we have a client who is well prepped, we can close a loan in 10 to 12 business days. We do not like to push it this fast if we don't have to, but if something happens, let's say you have a loan fall through with another lender, and we can get your client's application in, get all their documents, we can go through, review them, and know that we're going to be fine for closing. We can get it done in 10 to 12 business days.
On the closing disclosure,
Yes.
if it's issued on like a Thursday or Friday, do weekend day counts towards the 3 days?
Weekend days do count towards the closing disclosure, which is actually really nice. And that's if your client gets in and acknowledges them, because sometimes they don't. And that's if they're sent electronically. If they're sent via mail, then no. We can't count because mail doesn't get delivered on Sunday. Yeah. Can you think of anything else?
That's all the questions.
Okay. I know. I'm like, I do this on a regular basis, and I can't think of everything. If you guys ever have any questions, this is everybody's contact information. Trinity, I'm sorry I did not put your information on here. This is myself, Tristan, and Brett. We're all more than happy to answer any questions you have. Trinity is also a really great resource. And if you can't get a hold of one of us, you can always get a hold of her. And then her email is loans@brickhousemtg.com. So if you need an additional contact person, go ahead, Trinity.
Thank you. Thank you.
So Trinity now lives in South Carolina. She is still, right?
Yeah, South Carolina.
Okay. And she is an integral part of our team. She will actually be here next month. So if you'd like to meet her, just know she'll be in here working in the office with me. So it'll be your chance to come in and meet the other half of our team.
Yep.
All right. Well, if nobody has any other questions, then I will just say have a wonderful Wednesday. Let us know if we can help you with anything, and have a great day.
Thank you.